Major support for these programs is provided by Bank of America Merrill Lynch and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank, Chase Commercial Term Lending. Additional support is provided by AVR Realty Company, LLC, Briarwood Organization, Bruce Mosler, Capital One Bank, Cassidy Turley, C.B. Richard Ellis, Chelsea Lighting, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Hal Fettner, Durst Fettner Residential, Friedman LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova Burns and Gian Tomasi, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, James Orphanides, Centurion Holdings, Corman Communities, Madison Realty Capital, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Massey Knackle Realty Services, Meridian Capital Group, Newmark Knight Frank, Sterling and Sterling, SJP Properties, Stonehenge Partners, the Wickoff Group, Urban American, and Ackman Ziff Real Estate, Ariel Property Advisors, Eastern Consolidated, Essex Capital Partners, Goldman Properties, Moynihan Group, Muss Development, RAL Development Services, the Spandrel Group, LLC, Rosewood Realty Group, Terra CRG, Triangle Equities.
They call them private equity funds. These are people who aggregate money from pension funds, fund of funds, high net worth individuals, a variety of people, and then they go out and they buy real estate. So today I've assembled 4 leading private equity fund or fund advisors to provide their insight on where they want to invest, what do they like to do in 2012. My guest today includes Kathy Corton, who's a principal at Brickman, Jordan Sokaransky, who is a principal at Westport Capital, Keith Rosenthal, who's the president of Phoenix Realty Group, and last but not least, my friend Jack Connolly, who is the executive director, director of acquisitions for UBS Realty Advisors. So since you are new to the Stoller Report, how do you look at the market in 2012? You know, as I would say a couple of years ago, the world has improved a little bit since 2008, 2009.
Sure. It's actually a challenging time because while the view of the world and the economy and macro in some segments and the markets where we invest is good, pricing is getting very aggressive. People are, in my opinion, not necessarily pricing risk appropriately. So you have to be very careful about what you're investing in, and especially if you think the interest rate environment is going to get, interest rates are going to get higher. What do you do in that context?
So what do you like today? I mean, you know, there are different asset classes, there are different types of real estate. I know I don't want to speak out of school, but Keith's specialty is really residential. That's what he likes. Jordan, I'm not sure, but we'll find out. What are you in the Brickman organization like?
Well, we've been investing and will continue to invest in both the debt and equity side of the equation. Distressed assets, looking for mid-teens types of returns. Our differentiating factor is a little bit that we're owner-operators, so we own buildings in these markets.
So you know how to, in case you take over the debt, you know how to operate the property later on.
Right, we're fairly agnostic whether we get paid off or we get the property, and we're certainly not afraid of it. And I think it gives us a little bit of market knowledge and in some cases some pipeline of deal flow because we have people on the ground.
You don't like this. Do you like buying distressed debt?
No, we're more a core buyer, core value add with some work that needs to happen. But the distressed debt is in our mind, it's not really the blocking and tackling of real estate. It's more of a temporary strategy and a legal strategy. It's great, and people do a great job.
I mean, people in the 90s when we had the RTC and we had that situation, if you were my former colleagues at Apollo or other companies, that was a great time. If you could buy distressed debt, you had the opportunities. But there's a certain, I think Kathy brings it down, you need somebody who knows how to take over the real estate once you have it. You like owning quality real estate. You're in there for a long term, as we were saying prior to the show. You're evergreen, as one would say. And you like all different classes. Keith, you've been involved in the residential rental markets for years, and you've been very active. What happened over the last year or year and a half? I mean, I remember sitting with you and Jay Michael, and there wasn't that much activity.
This low interest rate environment's a blessing and a curse. On the one hand, it's helped with real estate values. It's helped with financing. It's helped make this business a positive arbitrage business in terms of, even though we're in a low cap rate environment. But I think that what cap rate environment are you going to sell into when you sell the asset? So I think you have to and I'll get back to your more basic question in a second, but I think you have to have a strategy that says you're somewhat cap rate resilient, that you can pick when you're going to sell your asset and pick the market you're going to sell to. And for us in particular, that means we're buying cash flow. We're buying assets where we, as both as an operator and an owner, want assets where we can impact the NOI. We can take the NOI from point A to point B or C or whatever, and hold on to that asset and enjoy clipping dividends in terms of operating cash flow every quarter and making distributions to our investors. And if it's not the right cap rate environment 2 or 3 years from now, when we're through a lot of that business plan, we ride the asset. I mean, thank goodness we're in a part of the multifamily market cycle where, I think there's a way to ride it upwards.
Here's the question. I think not everywhere can you ride up and get these rents. I moderated a panel about 2 weeks ago, and I said to Bob Knackel, who was one of the panelists, I said, when people are paying rents, buying at the prices where these rents are so high, when the world is fine, people will be living on the 6th floor of an apartment in Lower Manhattan, on Suffolk Street and paying $5,000 a month with 4 people over there. When there's a glitch and then when the world changes, that apartment is not worth $5,000 a month. So people who have bought at these prices are going to have that sudden awakening. I think prices have reached a magnitude too high in the rental market. What's your thought?
Well, we're not in as much
I know,
rental, but
I'm
I do think it's very aggressive, and I think we're all kind of saying the same thing. It's a little bit of an artificial environment that we're living in, somewhat driven by interest rates. So, and what we try to do is, because we're buying distressed, is not as much as cash flow, but basis. So if you're buying a building at $200 a foot, or buying in a major metro, or
You're saying if the bricks are worth that type, we
right,
can say.
in a very basic analysis, it will usually come back to that. You might have up and downs, but.
And you,
well,
the guy from Connecticut?
Well, we have a very diversified.
The other side, I'm sorry.
The other side of Connecticut. We have a very diversified acquisition strategy. So we do get frustrated at times. We do feel like investors are chasing yield and willing to suffer lower returns, not commensurate with the risk they're taking. But we find that the whole country is available for sale, and it's a matter of finding the right price you could tolerate. And it's about identifying where there's selling pressure. So for instance, in the past year, we've been very active buying from muni funds that are under redemption pressure. And they hold a ton of revenue-backed bonds, which are really real estate financed instruments. And we've been very active in Florida in particular, buying muni bonds backed by large land transactions. And we're creating a very favorable cost basis senior in the capital stack and ability to get equity-like returns. And we feel like we're well protected in both a restructuring or a loan-to-own scenario.
And what about forgetting that debts and other things? What about real estate? Are you buying any real estate, or are you
we are
investing
doing
in that marketplace?
Absolutely, we're doing a lot of direct investing, a lot of rescue capital transactions where we're taking a participation in the recovery profile of the asset. We really are agnostic in terms of what shape or form a transaction comes to us in. We care about our basis, and we care about our respected return under different scenarios, whether it's the value add long-term loan tone scenario or a short payoff scenario.
Here's a question which I had discussed prior in the green room. When you, all of you deal with people who find you transactions, who may have a deal and they come to you and say, I need you as a partner. You can put in, I'll give you maybe 10%, 5%, you'll put the balance of the equity and then we'll raise the debt. How do you vet the partner? How do you make that decision of who you should be? Meyer Orbach is a good partner, but how do you make the decision who's a really good residential person, who's a good person to be in the hotel business with, who's someone who you want to do some office buildings with? How do you make that decision?
I'll answer for residential. The jockey obviously matters. Let's start with that premise. It isn't just buying the best bricks and mortar at the best commodity, pound per square foot price. And for us, it's not necessarily how big they are. It's how well do they know the local market we're investing with them. And New York is a particularly good example of that. There's a lot of every place has regional markets. New York, in my mind, has micro markets. Looking at Midtown versus 40 blocks away and being in Harlem, those are totally different worlds. And you want to invest with people who know their micro market. To me, that's a big part.
But here's the question. In addition to that, it's good to know that person who's in that micro market, but not every one of these people that in that micro market who could bring Jack a deal or Kathy a deal or Jordan a deal have the capability of dealing with an institutional investor.
That's true. One of the first things we do to vet our partners and sponsors and managers is present them with the material that they'll have to provide us each and every quarter. And if they can make it through that, and they've done that before, which is important because, it is daunting, but it is kind of a threshold issue. Do you have the back office and the staff? The other thing is, we have a tremendous breadth of assets already. And if someone comes to us and they could talk the talk and walk the walk, and they've done it before, it becomes more self-evident. And so you can see their track record and all that. And the biggest issue we have right now is going from, I need to find a deal and find a sponsor, to I need to tell people no quickly. Because the amount of deals are growing exponentially. The quality of deals is only creeping up.
We're pragmatic. Our goal is to find good opportunities, and with that comes maybe dealing with a partner who is less than capable in certain disciplines or aspects, and it's our job to supplement and make sure that our capital is protected, and we take a very hands-on approach to managing our relationships. And I'd say, we all joke in the office that we love to own Rock Center at a discount with a high-quality partner, but that's not available to us. And so we have to find off-the-run opportunities and really supplement resources.
Besides the fact that I've heard residential asset class, what asset class do you like, or if you had the opportunity, would be in a ranking of where you'd want to invest besides the stressed debt in assets?
It's where you think that asset class is in its growth cycle, and obviously the markets, but also what the prices are. So I might love Midtown Manhattan, but I'm not touching it.
Not at the price.
We're finding opportunities. We bought about 5 buildings in the Seaport District in Boston. We just bought a piece of debt there, and it's turned into the innovation corridor there, and it might have already just passed in terms of pricing, but that's been an interesting submarket that we've focused on for about the last year. We've done some inventory loans on condos that are at very low basis, but it's kind of, you know it when you see it.
You have a great condo project at 1280 Fifth Avenue today. Would you do another condominium? Would you invest and build a condominium? You had Fifth on the Park today. These have been planned, and they're in different stages. Yours is older, more mature, and it's taken a couple years. Is it worth is it the time to go back into the condo business because of the returns that you might be able to give to an investor?
Probably was a year and a half ago, you know, and it's on a ground up. Again, it's opportunity and price. So you look at where land prices are or shell prices are in the hot residential markets in New York, and they're $500, $600, $700. I'm not sure that makes sense. I don't know what you.
I think it depends what you're buying. If someone were to show us a broken condo deal today, would we be a buyer if we could buy it at a basis that makes it work as a rental, and that we hope as an alternative or a more upside strategy that we could exit as operate as a warehouse it, so to speak, as a rental, and then exit as a condo? We'd think about it, but we wouldn't price it that way. The problem with condo deals, just to put a term on it, is they're stopwatch deals, okay? You don't get to pick the market you sell into. So here we are at historically low interest rates. It is without a doubt having a huge impact on the momentum that we see at the sales we're having at Fifth and the Park and on Fifth Avenue, and the same with your building. We spoke earlier, they had good sales momentum, and we've had reasonable price increases. But who's to say that's where we're going to be a year and a half from now, where we're more into the recovery?
But I believe both of you have gone into these projects. Fifth and the Park was probably 2005, 2006, the initial time. 1280 had to be 2007.
Well, it's actually
Goes back earlier.
Contracted,
Right,
which kind of saved us a little bit.
Right, because you could have
land
been,
prices
you
were
could have been
cheaper.
finished, at the wrong time. You could have been sitting over there or on there.
We've avoided condos for the most part. We have some small condo exposure on land that's adjacent to apartments that we built. We like to say that one of the reasons we're still in business is we've avoided condos as an investment.
We feel the same way. I mean, we look selectively for unique development opportunities. New York's always a focus of ours, given it's our backyard, so to speak. But when we look at a condo deal and we see the risk profile and we see that our profits are tied up in those last units and you're behind a ton of debt that's necessary to make the returns work, and we compare that to buying existing improvements in other real estate asset classes at a discount to replacement cost and getting current cash flow, whether it's through the debt or in our direct property investments, that to us is where we want to play at this point in the cycle.
My apples are far away from me. They're near the Newman's Cookies. But when I used to have the apple next to me, and people see me on the street and they say, what's the next place? What's the next location? I mean, did I have the fortune cookie when I remember going to when they broke ground for Toll Brothers, property in Williamsburg? I didn't have the foresight, even though I did get involved in contract to buy something for Apollo, and which fortunately they waited 3 more years later, so they did well on the carpet factory. I mean, where is the next place? I mean, you have certain things in New Jersey. I've done shows on what's happening in New Jersey. Is Newark the next opportunity? Is it the next Hoboken of the world? I mean,
I have not focused on Newark and avoided it. The other parts of the Jersey Shore are so much more mature, but I see the next opportunities creeping out from the existing opportunities, moving west and east from Williamsburg, moving north up through Manhattan and into the Bronx, where there is public transportation and infrastructure. And I think any place that has that in transit-oriented development will eventually be successful.
Kathy?
I would agree with that. We see the housing stock too in the Bronx as being good potential. And taking away from there, call them the urban suburban centers, whether you're going up pick the metro line up through Connecticut and some of these smaller towns, but where you're within walking distance of the train station, but they haven't really turned around as much.
I mean, look, what about the Stanford market, which people had over there? There's a lot of buildings there. You may have been able to pick up the distressed debt that Terrace had, but sometimes you build too much in the neighborhood.
Well, this is going to sound a little far afield, but I think it's very informative of the transit-oriented development comment. They were interviewing the car companies and said, who are buying cars and who values what car they were selling? It was really about stick shifts versus automatics. And younger people care less about cars. This
was in the Wall Street Journal.
This was a surprise to me. It was just yesterday. I heard a report. They care less about cars. It's not as much a status symbol to them and not as important. I'm not saying it's not important, but not as important. And it goes back to the transit-oriented development. The expense, the time, the way people live their lives now because they don't work only over here and live over here. It's all mixed together now. And that informs housing. It's the same thing. It's all cultural.
You know, this relates well. There's a bank who I'm friendly with. They're based in Florida. They have a New York City great townhouse across the street from St. Patrick's Cathedral. And when they have their executives come in, they rent a zip car. And that's the key. You know, my son lived in Chicago. He was really nearby. There was a zip car location. So people don't need the cars. They can rent the zip car. They can have that. You know, I remember doing a show on downtown Brooklyn, which none of you have invested in truly in downtown Brooklyn. And I myself said, who's going to be able to absorb 1,955 apartments in downtown Brooklyn? They were all absorbed. I mean, because of what you said, the train, the ability, and so on. What's your thought about Lower Manhattan as a private equity investor?
Well, we made a mezz loan on 2 Lower Manhattan office buildings. They went in, we bought a first mortgage on one last year as well. And they were both situations where you had a lot of light and air, and there's some canyons in Wall Street, those office buildings. I just don't like, there's a lot of bad space there. But these 2 situations were both at or below, going back to basis, $200 a foot with good current cash flow. I worked in downtown Manhattan for 18 years, so I know there's been over and over again talk of it revitalizing, but it feels like it's going to stick, and residential has been moving down there, and you go there on a Saturday when 15 years ago it would have been empty, and it's vital. There's a lot of people.
Downtown,
and I'm talking the financial district.
The financial district is no longer financial. Wall Street has more converted apartment buildings from the office buildings than office buildings, and that's what has happened. The bigger problem with Lower Manhattan is that you do have these C buildings that we're talking about that have no light and air. They have nothing over there, and when they were converted in the mid-90s, they had these 421G tax abatements, full tax abatements, and now there's no tax abatement, so it changes the world over there.
I don't know, but I think it's got, 3 very strong things going for it. Amazing density of transit stops. People like to live close to each other and be able to walk back and forth. That is the New York, much less other places. People are valuing that more. Things couldn't be more compressed together. And money loves company. And could we be pouring more money, whether it's federal dollars, whether it's Port Authority dollars or private dollars, into what's going on? I mean, the Trade Center, the original World Trade Center, took 30 years to really take off. But once it was there and it was populated, there was a huge resurgence for downtown. I think it's going to happen all over again once we finally get to that. We're right in the
Jack
beginning
has
of
made a commitment. Last year, they recapitalized the building.
We spent almost $1 billion downtown. Both, Battery Park is finally finished. It's a wonderful place to live. So much residential on Wall Street on the other side. You add all the money spent on transit location, and now you have the brand new properties in the World Trade Center at rents where you have to rent in 40, 50-year-old buildings in Midtown. And the corporation is going to notice that and looking at new, more efficient space in the World Trade Center at the same rent that you get for older space in Midtown. That will change the calculus.
No, we didn't get to the subject of Newark. I like your opinion.
I think that development happens occasionally. Areas get skipped over, but it's an infill concept or domino concept. A neighborhood gets better than the neighborhood next to it gets better than the neighborhood next to it. I don't think we've quite gotten to Newark, but it's getting there. Between all the things that's gone on in Jersey City and Hoboken and Weehawken now, and I'm not necessarily saying it in the right direction.
But I think what
it's
Kathy
leading there,
said,
but I don't think we're there yet.
with regard to transportation, it's Hoboken and Jersey City has done well, even though if you're not in Journal Square, because you had light rail. Mm-hmm. Light rail has been able to help the situation. Mm-hmm. I think light rail, even in Connecticut, in certain markets, hasn't been successful. No. but you know, in the Stanford area where Antares tried to do that situation. What's your thoughts about retail? I mean, I had done a show on REITs the week before, and I had Kimco on, and they're, you know, that's their main business. Have you ever been bullish or active investors in retail?
I like to shop,
I know.
but we don't really invest in retail. Mostly because, to me, you don't control your destiny, and the box changes so much. You have to be, I think, very big if you're going to be in retail.
To some extent, I agree, because you know we invest in retail, but we don't have a large presence where we could, you know, leverage tenant relationships. So we've been very selective on where we've deployed capital within, you know, the retail space. But having said that, over the past 12 months, we've bought debt on, you know, several strip centers, 2 in California, 1 actually in Omaha, and these are, you know, good opportunities for us when you look at our cost basis and our, you know, our debt yield and where the vacancy is. You know, we don't mind leasing up some small shop space and maybe 1, you know, big box or an out parcel, but we're not taking on large anchor retail
Jack?
opportunities.
We're very intrigued by retail. If you look at the data on the retail usage by consumers, how it's changing with internet shopping and so forth and so on, it's continuing to escalate. Yet, and you look at the retailers and all the changes in names and bankruptcies there, when you look at the returns that have been earned on retail and the versus other asset classes and institutions, retail's been not that hurt and has performed better. So there's this intriguing mismatch between what the data says and how the returns are performed and what you see on the ground. I do think that there will be many more opportunities for retail as inflation increases and as the consumer balance sheet improves in the next couple of years.
Hospitality. You owned, you are in, you've been involved now. Why do you like hospitality?
At the end of the day, a hotel investment does throw a lot of cash to the bottom line, and like you, we ultimately focus on cash flow investing, and that's what it is. And I do think that when times are tough, there's no new supply of hotels, and that tends to firm up the existing assets, and it works well over the cycle. Yeah.
We've always gravitated to hospitality. We like the operating leverage embedded in that type of real estate.
You like being an operator of hospitality?
Yeah, we
I
find.
didn't see you behind the desk.
Well, we get our hands dirty. We do what we have to do. But you know, our approach when we buy a hotel, whether it's through the debt or as a direct property investment, is to focus on an underperforming hotel based on, you know, how the hotel performs relative to where its comp set is today. We're not betting on RevPAR growth. We're betting on turning around an underperforming asset. So that's, you know, I guess part of our investment thesis. And I would say one thing I find concerning about the hospitality market is the disconnect between debt pricing and equity.
Okay.
You know, equity investors are buying hotels at low cap rates and lenders aren't there.
I think my viewers got a pretty good perspective on what you people wanted to invest, how you want to invest, which assets you like. And I'd like to thank Kathy Corton, Jordan Sakaransky, Keith Rosenthal, and Jack Connolly, and I'll see you all next week. Thank you.